Hi, this is James Zhang, and today I'm here with Gene Trowbridge. So Gene has been around the syndication business for a long time, and I appreciate him coming on today. I recently moved, Gene, and I threw out a lot of things, but I still have your book. So I think you gave me this book a while back at one of these multifamily conferences we were at together, and it is a great book, and one of the few people who have spent some time doing books. My book that I wrote is definitely not this long, so I really appreciate anyone putting together something like that in so much detail. So I wanted to have Gene on today to really talk about, what he's seeing in today's market, but then also just talk about sort of what he does and how general partners are calling him in today's market. So Gene, maybe start from there, sort of tell everybody what you do. I have a list of questions here that I received. So I wanted to touch on them as much as possible. But if you want to just kick it off, and I'll just kick it over to you and tell
Sure.
us what you do, Gene.
All right, James. Well, first of all, if you would have just bought that book, I could have been retired by now.
Could have been that easy, right?
It could have been just, I
that
needed
easy.
just one more $27 sale on Amazon to retire. That's great. So thanks for having me. Well, I'm an attorney that practices in the area of securities law, and we write private placement memorandums, company agreements. We write subscription books. We work in all 50 states. There's no doubt about that. And I'm primarily a real estate guy. There are there we go. There are products that our firm does that aren't real estate, but I primarily do real estate. And I would say in the last 6 or 7 years, James, it's primarily multifamily.
Multifamily. Okay. So when you're going about writing these PPMs and operating agreements, what are the top sections that maybe you're tweaking, the general partner's tweaking in that process, right? So
Yes.
if for a limited partner who's reviewing these deals, what sections should they be paying attention to? Because I mean, it's a PPM is 90 pages or 100 pages, and the operating agreement's another 50 pages. So what top sections should they be taking a look at?
Clearly, there's some boilerplate going on in these documents. There are sections that are the same every single time, but a PPM and an operating agreement should be detailed enough about the specific properties and the specific rules. You want to be sure that when someone's reading it, they know that they know what property they're talking about, what investment they're talking about. You want to be sure, in case you ever get in court, that when the judge or the attorneys read it, they know what property you're talking about. I've been an expert witness, and I've heard judges say, well, I've read this document, I don't have any idea what it's really talking about. It's all boilerplate, so you can't do that. So when I start with my clients, I start with something that's called a deal structure interview. And it's about 8 pages of things that I go through. And I'm visualizing that right now, and I'm thinking about the areas that have the most detail, that I get the most input from the client on. So that would be the areas that have the least boilerplate. And certainly it would be the business plan. What are you doing with the property? The investment summary or the business plan, that's important. The fundraising, how much are you raising in total? How much are you raising from an individual? When does the fundraising start? Is there a minimum that you need to do to break impounds? And is there a maximum? Then I think the next thing we'd want to talk about is the sources and uses of proceeds. An investor could look at the table of sources and uses and see where all the money is going, and then they would use that table to compare this offering with other offerings. And that table, if you've never seen one, the table is going to have a bunch of columns, and some columns are dollar and cents, and some columns are percentage. And what it is, it's laying out exactly how we're going to spend the money we raise. For example, if it's a $10 million property and we're raising $3 million, the sources and uses is going to talk about what do we do with the $3 million. More than likely in that case, it's a $7 million loan. We don't worry about that. That's covered somewhere else. But what are we going to do with the $3 million? Are there fees? Are there reserves? Is there a down payment? Is there money for rehab? Is there money for reserves? So the sources and uses is quite important. The next section that's important would be the distribution section. What are the rules about how the cash gets distributed between the investors and the manager? And then I think the last thing I'd look at would be the authority of the manager. What rights does the manager have, and where are the places where the investors get to vote? I think that's important.
So
overall,
oh yeah,
go ahead.
Keep going.
So the authority of the manager. Overall, I think a passive investor needs to, even without looking at the PPM, James, I love these questions. James, if I give you my $50,000, what happens if something happens to you?
Okay.
So we should know about continuity. James, have you done this before? Okay. So we should know about your experience. James, if this is a good enough deal, are you going to invest in it? Yep. Skin in the game, if you want to use that. And then, James, if something happens to me, how do I get my money out? I think that's more of a discussion between the managing member and the investor than it is. All that's in the documents, but I think that's a general discussion we'd have. Those are the four major questions.
Okay. So if a limited partner gets a PPM operating agreement, your recommendation is really to start sources and uses, figure out sort of where the equity is going, make sure it's property specific, obviously, figure out fees, reserves, rehab. And then once that money is raised, how are they going to distribute this money based on the authority of the manager? And then these questions around continuity, track record, skin in the game, and how do I get the money out if I need
I think
the
money.
So.
And that's kind of the order in which I write my documents. Okay. We start with explaining the business plan and the fundraising. And then if you would, Article 3 is sources and uses. Article 4 is distributions, and Article 5 is the authority of the manager. Those would be, in my documents, 3, 4, and 5, the guts of what's going on.
And then, so I guess, has anything, since this COVID-19 has come out, I don't know how many documents we've written since it came out, but anything that's changing or is becoming more important for general partners, limited partners in this current environment?
We've written a few documents. As we're recording this, we're only, a week into April here. So we've written a few documents already, and we have put a risk section in the PPM to talk about the risks associated with buying a property when there is this virus going on. We certainly are going to talk about the risks of changes in our plans for revenue generation. We're going to talk about changes in our plans of being able to make the mortgage payments. We're going to talk about, would we ever go to the lender for a refinance or a forbearance? We'd expand the risk section to talk about what this virus is doing to the real estate and the lending world.
Is there anything in the standard docs that, because of something like this, it changes the authority of the manager, it changes distributions at all? Or do you always go back to the document and say, well, the document says we need, 50% control, and regardless, but there's no, like, it seems like Trump and some of these governors and states are saying, look, this is a emergency response disaster. Is there anything like that in the documents, or is it always sort of the letter of the law in the documents?
Well, that's why I said we should be looking at the authority of the manager, and that's Article 6, and Article 7 is the voting rights of the members kind of flow together. But for the most part, there are two choices in the documents I write. Syndicators who are less experienced and are more concerned about their ability to raise money, and that may be sounding cynical on my part, probably put in that they're going to let the investors vote. We're going to not make any major decisions unless the passives vote, and typically it's a 50% vote. With 50% vote, the manager can do what they want. An experienced manager with a good track record, with a lot of repeat investors, is just going to take all the authority. So I'd look right at Section 6, and I'd look to see what is the authority the manager has related to selling, refinancing, and exchanging the properties.
So the more experience in the voting rights, it just says they have full authority?
Right. The more experienced sponsor always just simply takes full authority.
For refinances, forbearances,
maybe for everything.
Selling. Okay.
Maybe for everything. An inexperienced manager might take full authority for everything, except there might be a bullet point in there that says, well, we might have to vote on a sale or a refinance.
And then, is there any specific language, or does it matter if it's a negative action or a positive action on the property? Because it seemed, like whether it's a refinance, sell, or forbearance, all those things, let's say for a less experienced investor, they're going to have to get the 50% majority vote from their investors?
Well, here's what I think, and we're a little early to understand what this is. I haven't had a client at this point go to investors where he needs their vote and explain to them a forbearance agreement. And you know all about those agreements. They're going to, there's great impact on what the company can do after they enter into a forbearance agreement with the lenders.
Right.
So in every case, it'd be a good idea to communicate with your investors and say, if we go into this forbearance, there's not going to be any distributions until we get out of it. Okay. You got to tell them all that. Okay. So I don't think the authority relating to a forbearance is much different than the authority relating to a refinance. I think the manager either has total authority or the manager is going to get a vote, and in that case, we're going to have to educate the investors, which could be a real challenge today, wouldn't it?
Well,
no investors know what the hell we're talking about if we're talking about forbearance. So that's going to be a challenge.
Do you, and I've been a part of some of these deals where they just send out an email and everyone sends back a vote. Is that sufficient for
yes
the voting rights? Okay. All right. And then if they get the 51%, they're good to go on the 50% majority. Does that include, I mean, this is a nuance, but on some of these deals, the general partner gets 20% of the ownership right off the bat, right? So does that count in the voting rights, or is that a nuance by operating agreement? Does that question make sense?
That would depend on the operating agreement. Okay. Your comment is the manager gets 20% ownership, which relates to percentage interests.
Right.
And votes are based on percentage interest. So if I knew that was going to happen, I may very well say that the vote has to be everyone except the manager.
Okay.
I might say that. If it's just 20% of the cash flow, but no ownership, which happens, then we'll just let the people vote. So that would have to be individual based on the structure. Now, James, one of the things I found in my experience is you can never get everyone to vote. Are they on
Right.
vacation? They're doing this or that. So I often let my managers take a little different approach that, hey, we're going to do this. I need 50% approval. If you don't approve, send me your vote.
Okay.
And if I get 51% negatives, I won't do it.
You won't do it. Sure.
Yeah. So just let the people who don't like it speak up and let the other people just ignore it and move on.
Anything else on PPM operating agreements, maybe structuring these things besides the risk section and maybe looking at the authority a little bit more? Anything else on that?
No, I don't think so. And I think we covered question 4 then.
Yeah. So let's jump into number 5.
That's a good question. Yes.
Number 5 is, look, there's been a lot of deals, maybe even January, February, went under contract and they raised 5 million, or even let's just use your example. They were trying to raise 3 million, and they're at $1.5 or $2 million right now. What happens? They can't close. Do the general partners just send all the money back? What happens in something like that? Have you had that happen, or maybe share?
Sure.
Yeah.
Sure, I have. And here's how most of the deals you see are structured. They're structured with a minimum and a maximum raise. Okay. Let's say in our deal where we're going to raise 3 million, 1 million is for rehab. Okay. And 2 million is for down payment and closing costs. So James, I'd write the offering document that says we need to raise 2 million to break impounds, which is just a term. And at 2 million, we can grab that money and close and buy the property. We can continue to raise money after that to get to the 3 million of our maximum raise. Okay. So generally the minimum is an amount that you'd need just to close. So if we raise the minimum and we can close, I guess it's a business decision on the manager to whether they will close and or go forward. Okay. And the manager probably has the authority of that because that's what the minimum says, the amount needed to close. Okay, fine. So that's an easy one.
Does the limited partner have a chance to, because let's say the limited partner thought, hey, they're going to raise $3 million and $1 million's rehab, and that's the only way this business plan is going to work. And all of a sudden you're limping into the deal with you're short $1 million and
right.
You run into coronavirus and now you can't even support the deal.
Well, the operating agreement would talk about that. The operating agreement would say, what if we close at a minimum and buy the property and we don't raise the rest of the money we need? Generally, the manager is going to have 5 or 6 different ways to get that money. And one of them is just extend the money raising. You know, in a Reg D offering, you can raise money really for a year. So we could extend the money raising period and do some other things, but that's a risk, isn't it? And so we hope that the sponsor knows what they do. But let's take it the other way. We had one last week where it was a $5 million raise. All the money was in the bank. Everything was done, and the lender backed out.
Okay.
So your question is, what do you do with the money? Well, for a reasonable period of time, I think the sponsor can keep the money and try to get a new loan.
Okay.
Maybe there's other loans out there, but at some point, and there's no securities law about this, but I would say after 90, 120 days, you'd have an idea whether you're going to get this deal financed. Send the money back.
Okay.
Sometimes we do blind pools. We raise enough money to buy one property, then we buy it. Then we raise more money for the next property, but we never find the next property. So we give the people their money back. And it probably would be written in there, given a certain period of time, if we hadn't placed the remaining cash, we'll just refund it.
Do
That's fine.
you, the investors coming in, let's say back to the example of post close, does that impact the investors at all, or are they given the same rights and
The same
ownership?
rights.
Same rights. All right.
The
So
same.
whether you,
My feeling is that is the first $2 million. Thank you very much. We bought the property.
yep,
That's terrific. The
yep.
last million gets us the money to rehab it. Thank
Okay.
you very much. Collectively, we've got a property that we can rehab.
Okay. So same ownership, but
Yeah,
okay. Okay.
same ownership.
All right.
So there's number 6. What happens if you raise the money but you can't close? You give it back. Give the money back to the investors.
Okay.
And your document probably says something about interest. I would say that if you're going to be raising money for a period of time and it's a large amount of money, you might have it in a savings account. You might have earned some interest. Maybe the investors would get that. But for the most part, there's so little interest today, it really doesn't make any difference. Just give them their money back. That's a risk, though. What if the sponsors spend $200,000 on due diligence and some hard money, and that's all gone? Does the document allow the sponsor to offset their out-of-pocket costs and only pay back $2.8 million? We'll have to look at the document and see.
what's typical?
That would be typical. If we were in a period like this, that's clearly typical. Okay.
So the GP would net out
Sure.
DD cost and the hard money.
Well, if it's his hard money,
Yeah.
the other side of the coin is whose hard money is it? See, if we break impounds, that could be, we'll grab some of that and make that hard money, and then we'll wait to close.
Right. Okay.
But if that's the case, well, then it's the investor's money and the investors lose the money. But if just the sponsor's money, I think that's a business decision. I think you could certainly get the money back. I think if you want to continue to be a syndicator, you might think about eating some of that.
Eating of it. All right. And maybe doing 50-50.
Or something like that.
Yeah. Yeah, because I mean, we went through this. So at the beginning of March, there was 2 or 3 deals that were best and final. People backed out of the deal early just because the amount of hard money they would have to put up. And let's say the amount of hard money is 1% of the purchase price. That's hard already. But then also just to lock the rate on the loan was 2% of the loan amount. So all of a sudden they're 500,000 to $1 million deep into the deal in pursuit costs. And some general partners just weren't willing to do that with the uncertainty. So
if I knew if my client knew all that was going on, we'd write that. That would all come out in the deal structure interview. And so I'd have clauses where we discuss.
So this is coming up more right now. So we don't know how April, May, June collections are going to be. And most people have maybe a month of operating expenses, a month of mortgage payment in the bank for their property. And if collections dip 30, 40, 50%, then they might need to either do the forbearance or do a capital call. And the market's been up, everything's been great. And so nobody's had to do any capital calls, I would say, the last 3 or 4 years. So maybe explain what happens when a capital call happens. Yeah.
Did you watch my webinar on capital calls?
I did.
Yeah.
So there was a lot of different ways to get money out, and I never thought of any of them. So maybe you can touch on sort of what are common ways that people are doing capital calls, and then the impact to investors, those different ways.
Well, I figured you watch this because I see this question and I see the choices. The first thing to do is we need to look at the definition of distributable cash. What is distributable cash? And generally, it's whatever the managing member says is distributable, taking into consideration the future needs of the property. If things are going bad, the very first thing you want to do as a manager is look at your definition of distributable cash and see if it's reasonable to stop distributions, to hoard cash. That's the very first thing you would do. And that's an acceptable, that's always an acceptable thing to the investors. And they want to protect their equity, not necessarily just get cash for groceries. They want to protect their equity. So that's the very first thing I would do. The next thing I would do is I would go to the operating agreement. And the first thing we can look at is, can we raise money from third parties? Which would be back to, do we have the right to refinance? Do we have the right to take out a second? Do we have the right to go to people who aren't in the deal and simply raise money? We could raise money from a loan. We could raise money from a clause in the operating agreement that says, hey, we can reopen fundraising and we can raise money from new people with a new class of units. Okay, and that has all sorts of a ramification. Would they have priority payback, whatever? We could do that. So you look at distribution first, then you go to third parties. Now you've explored those two options and you're still short of cash. The operating agreement would say that the member can make an advance. And it probably says exactly what the interest rate will be on the loan.
So that's general partner?
The managing member.
Okay.
You keep using general partner and limiteds, and I'm in the LLC world, and so it's a managing member and member. Gotcha. But it's the same thing. Who cares? If the manager has the money, the manager can make an advance. And it would carry, today that we're writing those documents where the manager probably gets around 6% interest on the money that they advance to the fund.
So is that preferable than going back out to, I mean, it's cleaner. It's just from one person, or potentially one person.
Practically speaking, the last thing you're going to do is the last place you're going to be successful is a capital call. So I'm going through where you're going to be successful. Hold off on distributing cash. Go to a third party who's in the business of lending money and see what you can do. See if the manager can lend money. That would be called a manager advance. And then go to the big hitter investors you have, the members, the limited partners that are in your deal who have money, and on a one-on-one basis, see if they will lend to the company. And the company agreement will give you the authority to negotiate with those people an individual loan or a couple individual loans, which will go to the company. And then there's an arm's length negotiation between the manager and those members as to rate and terms on those loans. I mean, if you only need $100,000, maybe someone will fund it, right? Or just one or two people.
So most of those loans, they're not going to be collateralized against the
property. I'm going to come back to that in a minute. And then the last thing, go to a strict capital call. And that's kind of interesting because, number one, the operating agreement may say you can't do a capital call, period. If the operating agreement says you can't do a capital call and you really need one, everything else has failed, and we're running into the risk of losing the investment, you simply have to amend the operating agreement. To go to all the members and say, okay, dire times, we need to amend the agreement, and here is the plan for the capital call. Okay? The operating agreement may allow a capital call with a 50% vote of those who would be affected. Majority vote. Without taking a vote. I mean, 50% vote. You can just go ahead and do it. Okay. Thirdly, the operating agreement may just say the manager can make a capital call.
Okay.
I have only one, and I'm a lot of clients, James. I only have one or two clients who are bold enough to put that in their document, that they can just simply make a capital call. And their offerings are totally accredited investors,
Right.
all people with deep pockets.
Okay.
And I think that the client I'm thinking about is in 18 deals with me. So, wow. So that just gets us to a capital call. Most of the provisions that you see on a capital call is we want to get money from the members. If the members send in money, we go back to the percentage of ownership and change everything. Let's say we raise $3 million.
Right.
So everyone has their percentage interest. Now we need another 300,000. Two people put in 300,000 through the capital call, 150 each. Well, now the total stack of money is 3.3 million, and we just simply
dilute everybody else.
recalculate the percentages. Okay. Now the more draconian offering that I write, where I can just make a capital call, does have some very strict provisions if you decide not to participate. But you know, as an investor, you knew that when you invested. It's in writing.
Right.
You know what the deal is. If it's a thing where we can't make a capital call unless we amend the agreement, you know what that is. If we can make a capital call and a 50% vote, you know what that is before you invest. So there's no surprises.
Okay.
Okay. And we talk about that in the deal structure interview. How do you want to play that?
Okay. And then so let's
I got to add one more thing.
One more. Okay.
Depending upon the lender, none of that'll work. The lender might say no member loans, no manager advances, and no capital calls.
Okay.
They may say that. Wow.
So, I mean, we're sort of getting into this is, so right now the SBA has some of these loans, PPP, EIDL, that might require some of these advances. And so we're getting clarification from Fannie and Freddie right now on whether or not you can take those and if it's non-recourse or recourse and all that. So, but jumping into this next question around, the two things that people have been talking about to me are forbearance, but then also interest reserves. So let's maybe talk about forbearance. I don't know, is there anything that needs to be done on the forbearance side if a general partner decides to go into forbearance, or is that already covered?
My feeling, unless the lender says modify your operating agreement, it's already covered. Okay. But I do think it's possible that we're going to find lenders who say, well, you need to make these changes. Okay. They may just say you can't have member advances, you can't have member loans, you can't have a capital call while we're doing this. Okay. So that's, I would just leave that, might be lender driven. Other than that, I don't think we need it. Clearly, communication. Right. Okay. Now, preferred return on escrow. I know where this question came from. This question came from when you and I were doing our last deal, and we're throwing the example of getting a brand new loan. You were going through and talking of all the provisions of new loans, and you came to a deal where 1 year of debt service or interest, whatever it was, has to be escrowed with the lender.
Yes.
Okay. Let's say that's $2.25 million.
Right.
Okay. $200,000 a month. Big deal, right?
Yeah.
$200,000 a month. So we have to raise an extra $2.4 million.
Right.
It sits in the bank earning what? Nothing. At least it's not negative interest yet, But we structured our deal to have a 6% preferred. So where do we get the 6% on the $2.4 million? We're not getting it out of operations.
Right.
And in fact, we may not be able to make any distribution. So what we're doing, we may find ourselves in a position of accruing the preferred return that'll be paid on the back end of the deal. This is going to be an issue of structuring that we have to work side by side with the lender. As the lender tells us this, the operating agreement changes. We have to know, and the amount of cash that you raise changes. Right. It's going to be a very fluid situation, but if you raise the money and you say there's a preferred return, you're in trouble. This might be a great time not to deal with preferred returns, or tell the people we're going to do a preferred return, but not on the 2.4 million.
Okay, so that would be in the operating agreement or the PPM?
Operating agreement, yeah, the operating agreement. You can do that.
Agreement. All right.
You can tell them just simply what that the preferred return is based on. Well, let's say we needed 3 million. Now we need 5.4. Okay.
Right. Yeah.
You can just say the preferred return is based on 3 million. And then the 2.4 sitting in there. We don't know how long it's going to sit there. We're not going to pay a preferred return. We may get it back.
Right.
Fine.
Okay.
Isn't this fun?
That's gonna be tough, I think, for people to swallow. So I think we talked about. So maybe we talked a little bit about distributable cash here, but in this question, let's say you did a refinance in January of this year, and that original $3 million deal in equity that you raised, you got 1.5 million, which is great. And now, is there an amount that you have to distribute, or is there an amount you can hold back? Is that articulated in the operating agreement, or is it up to manager's authority once again?
You have to read the definition of distributable cash, which in my operating agreement is about 150 words long. And in there it says, looking at the future and dealing with an estimation of reserves that are needed, no cash ever has to be distributed. Boom. The manager has total authority. I have someone right now, a client who's doing 5 refinances right now, and their goal is not to distribute anything for a year. That's what they're telling their investors. Here's the plan. We're going to, and why are they refinancing? I said, why would you do that? You take a good property that's cash flowing, you put a brand new loan on it, which tells me debt service is going to go up.
Right.
We're in a period of falling revenue. Why would you do it? And they said, well, we're refinancing at a lower rate.
Sure. Yeah.
We can pull money and have the same debt service. And I have another client who's trying to refinance 2 properties without pulling anything. Let's just replace the loan at lower interest rates and increase our cash flow. We don't need any reserves. Well, that's the business decisions that managers make.
Okay. So it's up to the manager at that point to make that decision. Let me see. So I think we covered.
That's Article 6. There you go.
Article 6, majority of the managers. Okay, perfect. Anything else? I mean, you work with a lot of clients. Any other questions that you're getting right now that you would want to share the answers to, or any questions out there that people have been asking you that I maybe didn't touch on?
Yeah. Well, I received a question yesterday that I didn't know the answer on.
Okay.
And you might. Okay. The question is, do the PPP loans, or what are the whatever it is?
EIDL. Yep.
Do those loans apply to the entity that owns the property and or the managing member, the member LLC, and are they available to those people? And I said, I have no idea.
So since those loans are about 1 week old and they changed the documentation and the rules, it seems like daily. From what I've seen is that if you're, let's say the borrower LLC who owns the apartment and has the loan, most of their income, or almost 99% of their income, is coming from rental income. And a lot of these SBA loans are saying if all your income is coming from rental income, you are ineligible for these loans.
There you go.
So that's the simple answer. The trickier answer is, let's say you employ a third-party property management company And that management company has the employees on their books. And their income comes from fee income, management fee income, and it is not from rental income. And they employ less than 500 employees. And I have seen them applying for PPP.
Mm-hmm.
And so if your third-party property management company is less than 500 employees and they run the payroll for your property, then they could apply for those four, let's say for 200 unit property, those 4 employees, and you could get potentially 2.5 months of payroll covered.
So let's go to the managing member.
Okay.
Some managing members do the property management and the asset management in-house and collect revenue from the company that owns the property.
Okay.
They could, and they have less than 500 employees.
That one slice.
What?
Yeah, I could see that. If not the borrower LLC, but the other LLC that maybe pays the payroll of the property, as long as their income is not coming from net rental income.
No, it doesn't come at all from net rental income.
Yeah.
It's fees. Now, if the manager uses third-party management,
right,
then back to your example, the third-party property management may definitely apply. So I think there's more to be learned on that.
Yes.
And stay tuned.
Yeah, and I mean, the PPP has a little bit. It's non-recourse and it's no collateral really required. Whereas the EIDL, we're seeing if it's above a certain amount, they're requiring recourse and they're requiring collateral. So I could see that being more of an issue for people.
Good.
But I guess Gene, what's the best way for people to reach out to you if they have any additional questions about starting a new PPM operating agreement or anything like that?
Sure, I'd love to answer their questions. That it doesn't cost anything. Just call me and discuss with me.
I think I'm going to give you here.
There we go. There's
my
direct phone number. The 949 number gets me directly as I'm working virtually. Okay, which as you can see, I'm working virtually, and that will come right into my office here. And then my email at the firm, Crowdfunding Lawyers, is gene@crowdfundinglawyers.net. And this was great. A lot of information we covered. Hopefully we didn't get into the weeds too far, James, but I think this will be of value to the people who are watching this.
No, this is great. Thank you, Gene, for coming on and joining today. I mean, I think there's a lot of moving pieces in today's market, but Gene is definitely on top of it. And if you need any help with your next operating agreement or PPM, definitely reach out to him.
Thank you. Thank you, James.
All right. Thanks, Gene.